In today's real estate exam prep video, we're going to continue studying those key real estate terms you have to know for the real estate licensing exam. And today we're going to do numbers 84 through 92 of 300. So let's get rolling. Hey everyone, my name is Vojchehoske and welcome to the Real Estate Classroom YouTube channel, where my mission is simple here. I just want you to pass your real estate exam the first time. Understanding, knowing how to apply these key real estate terms goes a long way for you to achieve that goal. So let's look at today's key vocabulary words. The first one we're going to talk about is number 84 of 300. It's purchase contract. Now it has an AKA. A lot of students get confused with this, but purchase contract or purchase agreement, they mean the same thing. Just kind of depends on what part of the country you're from and what term that they use. Now, a purchase contract is a binding contract between the buyer and the seller, and it establishes the details, the specific details of the home sale transaction. For example, the purchase price, the closing date, will there be inspections or not, the condition of title, will there be a financing contingency? The purchase agreement it outlines all the specific important details of the transaction. The key to remember, it's between the buyer and the seller, unlike the listing contract, which is between the seller and the real estate broker. Number 85, earnest money deposits. Now, many times, most of the time actually, written into a purchase contract is earnest money. How much is the buyer offering as earnest money? That is something that's negotiated between the buyer and the seller, and it's as much a part of a purchase contract as negotiating inspections or closing dates or the purchase price or whatever the case may be. There is no standard. There is no law that says that earnest money has to be a certain amount. It is an item that's negotiated between the buyer and the seller. All right. Earnest money. It's an upfront deposit that the buyer applies to the purchase of a home when delivering an initial offer to purchase to the seller. So that's all it is. Earnest money deposit is just that good faith gesture that, hey, I'm serious about buying your home. Number 86, trust account. What is a trust account in real estate? Well, let's look at the technical definition here. It says a trust account is a legal arrangement via bank account which funds or money or other assets are held by a third party called a trustee for the benefit of another party called the beneficiary. So let me simplify this in terms of what you need to know for the real estate exam. Every designated broker in every state in the United States must have at least one trust account. And that trust account is for other people's money. Even if at some point down the road, some or all of that money that's been deposited into that trust account will become the broker's. The broker cannot take their share of that until they reach that point. So let me give you an example. Let's say that, well, first of all, let's look at real estate. All right. So the broker has a trust account. That broker is considered a trustee. And whoever puts their money into that trust account, that broker's trust account, is considered the beneficiary. So let me give you an example. A buyer gives a $500 earnest deposit check to their agent for an offer that they made on a home. So once that offer is accepted, that $500 gets put into that trust account of the broker's until the deal is consummated or terminated, which means the transaction closes or the deal falls apart and the money is returned or given to somebody. That's what a trust account is for. It's there to protect the beneficiary, protect their money from things like bankruptcy. So let's say the broker has to file bankruptcy. Trust accounts are exempted from creditors. Creditors can't come and take money that's out of that trust account because that money is not the property of the brokers. The broker is simply just holding it for them until a future date. Now, give you another example. Let's say that let's say that a buyer is buying a piece of property for $100,000 and they write a $100,000 earnest check, basically the whole amount, up front with the offer. The broker puts that money into their trust account and it's 30 days until closing. Now, the broker is entitled to $7,000 of that $100,000 in the form of commission. The broker can't go in and take that money until the deal is consummated or terminated if there's a, like a cancellation fee or something in there. But let's say in this example, the broker's going to have to wait until that deal has been closed. And that point, they're legally entitled to their share, their $7,000. So they would be able to go and deduct the $7,000 from that $100,000 that they have in their trust account because they earned it contractually. So let's look at other people's money. What are examples of monies we put into trust accounts? We put earnest deposits. We put rent. Maybe there's a property manager, right? So we have rent money. We have security deposits. Whatever the case may be, that's other people's money that goes into those trust accounts. Now, one other thing I want to say about trust accounts, that trust accounts are very much governed by each individual state-specific law. So in some states, a trust account for a real estate broker must be non-interest bearing. In other states, they allow the interest to be collected and the broker can keep the money. In some states, it can be non-interest or interest bearing, but the interest has to go to a nonprofit. So there are a lot of varying rules and regulations around trust accounts. So you have to make sure that you know the rules in your state for your state side of the licensing exam regarding trust accounts. Because I guarantee you're going to have questions on the state side of your licensing exam regarding trust accounts in your state. Number 87, what is a lease option? Well, first of all, a lease option has a couple of AKAs, also known as. A lease option can also be known as a lease with an option to buy, or a lease with an option to purchase, or a rent to own is another example of a lease option. All right, so let's look at the legal definition. A lease option is an agreement that gives a tenant the choice to purchase the rented property during or at the end of the rental period, or what we call the option period. It also precludes or prohibits the owner from offering the property for sale to anyone else during that rental period or that option period. That is a lease option to buy. So I'll give you just a layman's example. Let's say that you own a rental property. You want to sell it right now. The current tenant is the first person you go to that says, hey, do you want to buy this property? You live here already. I'm going to sell it. And they say, listen, I would love to buy this property, but I work for a company that may be transferring me in 3 or 4 months. I don't want to buy the property until I know for sure. So a lease option is drawn up and it allows that tenant to purchase the property within a option period, a time period. So in this case, 3 or 4 months. And then during or at the end of that 3 or 4 month period that's indicated in the lease option, the tenant can convert that into a purchase contract and purchase the property. If they don't exercise, that's a legal term when we're talking about options, if the tenant does not exercise their right to purchase the property at the expiration of the lease option, then it allows at that point, the seller can go ahead and sell it to somebody else. But one of the things that it does is it prohibits the owner during that 4-month period, that lease option period, from selling it to anybody else. That is a lease option. And if they're used correctly, a lot of times lease options, rent to own and stuff like that, they have a bad stigma attached to them for good reason. A lot of real estate investors really take advantage of tenants using these, but there is a legitimate reason in situations when lease options make a lot of sense. Number 88. Number 88 is equitable title, or sometimes known as equitable interest. Equitable title refers to the future enjoyment of that property. Equitable title is the benefits, what we call the bundle of rights. I did a video on bundle of rights that a buyer will get to use and enjoy when they become the legal owner. So there is legal title and equitable title. So I own the property outright. That means I have legal title to the property. You and I enter into a purchase contract. Closing is 45 days out. I still have legal title or legal ownership, but once we sign that purchase contract, you have equitable title. Remember, that means when it closes, you're going to enjoy all the future benefits, the bundle of rights that I have. I'm going to transfer those to you. So in a sense, it's a future ownership, if you will. It establishes future ownership, but it technically and legally refers to the future benefits through that ownership that you're going to get when you close on the transaction and purchase my house. That is equitable title. I also want to talk about equitable title when we talk about deeds of trust. And I did a video on deeds of trust, and they're very complicated, or I should say very confusing for most students. So I'm going to put a link to that video right up here in the upper right-hand corner. Might be a good idea for you to watch that video. So in my state, in Nebraska, we use deeds of trust or trust deeds. And so let me kind of walk you through the process. So an owner owns a piece of property. They transfer title to me. I'm buying that property. I now have legal title, but I also didn't pay cash for it, so I have to borrow the money. So what's going to happen almost simultaneously at closing is the seller transfers legal title to me, and then for a very brief nanosecond, I have legal title to the property. But then, because the seller needs to get paid and the bank's loaning me the money, the bank's going to loan me the money and I have to sign what's called a deed of trust or a trust deed. So mechanically what happens is I no longer have legal title. I transfer that legal title to what's called a trustee, and I become the trustor, and the bank is the beneficiary. So there's three parties involved. The reason I bring this up is because as soon as I sign that deed of trust or trust deed, I now have equitable title and the trustee has legal title to the property. Now, once I pay off the note, the money that I borrowed from the bank, then the trustee signs legal title back over to me. And then, of course, I have legal title. But up until the point that I pay that loan off, I actually have equitable title. It is very confusing for most students to grasp, so please check out that video again that I have in the upper right-hand corner. Number 89 is bill of sale. Bill of sale. A bill of sale is used to transfer ownership or title to personal property, or sometimes known as a chattel. All right? Many times in a real estate transaction, we have real property, and included in the sale is personal property. Give you an example. Maybe there is, we're buying the house, but there's a refrigerator that's in that house. That's personal property, but it's part of the transaction. So we use a purchase agreement to negotiate the terms of the sale. We use a deed to transfer title of real property at closing, but then we use a bill of sale to transfer the title to that refrigerator from the seller to the buyer. It is the legal evidence or proof that title has been transferred from one party to the other for personal property. Number 90 is marketable title. Hear that term a lot in the real estate world. So let's look at the legal definition. Legal title is an implied promise in a contract when a seller is selling land to a buyer that the seller will deliver marketable title to the buyer at the date of closing. So what does all that mean? Well, here's what it simply means. The seller must deliver to the buyer free, clear, marketable title, meaning a title, remember ownership, title, free of any liens, any encumbrances or easements or other defects such as lawsuit at closing. That is basically free, clear, marketable title. Number 91, auctions. An auctioneer will allow competitive bidders to bid up the price of the property until a single bidder wins. So it is what you would stereotypically think of when you hear an auction. So the property is for sale. We have the auction's going to go off on a specific date, a specific time, and then everybody that's interested will then submit their offers, and there is an auctioneer doing that fancy language many times. Sometimes not. Sometimes it's an online auction, but when you think of an auction, you're thinking of that auctioneer going, sold, you know? So, and that's essentially what happens. So you have a whole group of people, and they're bidding on this farmhouse or this land or whatever the case may be, and the price is going up and up until there's only the highest bidder, and then boom, the property is sold. Now, there are two types of auctions that you have to know about for your real estate exam. There's absolute auctions and reserve auction. An absolute auction is the bidder's going to start, or the auctioneer is going to start at a certain dollar amount. So, and wherever it ends up, the highest bidder, that is the final sale price. Let me give you an example. Maybe the auctioneer starts out at $50,000, but the highest bidder is $25,000. If it's an absolute auction, then the sale price will be $25,000. Now, you can also do a reserve auction where there is a secret minimum bid that must be achieved. Otherwise, the seller does not have to sell. Now, typically the bidders don't know. So this, in the same scenario, maybe the auctioneer starts at $50,000 and there's been several bids up to $75,000, but the reserve auction was $80,000 and the highest bidder is $75,000. Well, the $75,000 highest bidder does not get it because they didn't reach that minimum bid of $80,000. That's a reserve auction. Number 92, errors and omissions insurance, commonly referred to as E&O insurance. E&O insurance is an insurance policy, and it protects a business or an individual from mistakes or errors made during their professional services that they provided. You and I, real estate professionals, we have to have errors and omissions insurance. So if we screw up a deal, make a mistake or whatever, then we have insurance to pay for those mistakes. All right, if you're going to continue studying for your licensing exam, do me a favor, check out this video right here. If you haven't subscribed, check out this, or click this little circle to my left, comments and questions down below. That's all I got for this video. I'll see you guys next time.